Today we're diving into the world of monopolistic competition, a fascinating market structure that sits between perfect competition and monopoly. In this type of market, many firms compete, but each offers a slightly different product. This differentiation is key as it allows businesses to attract their own group of loyal customers. Throughout this video, we'll explore how product differentiation shapes the market, the differences between short-run and long-run outcomes, and why firms often operate with excess capacity. Let's start by understanding what makes monopolistic competition unique. Monopolistic competition is characterized by a large number of firms, each producing similar but not identical products. Think of coffee shops, clothing brands, or restaurants. Each business tries to stand out, but they all serve a similar basic need. This structure means that while firms have some control over their prices, they still face competition from others offering close substitutes. The result is a dynamic market where innovation and branding play a crucial role in attracting customers. Product differentiation is at the heart of monopolistic competition. Firms strive to make their products stand out through unique features, quality branding, or customer service. For example, two coffee shops may sell coffee, but one might offer organic beans while the other focuses on fast service. This differentiation creates consumer loyalty and allows firms to charge slightly higher prices than their competitors. It's this constant effort to be unique that keeps the market vibrant and competitive. Let's look at some real-world examples. In the smartphone industry, companies like Apple and Samsung offer devices with different designs, operating systems, and features. In the restaurant business, each eatery might have its own signature dish or ambience. These differences, whether big or small, help firms carve out their own niche in the market. Even toothpaste brands differentiate through flavors, whitening power, or packaging. This variety gives consumers more choices and keeps firms on their toe. In the short run, firms in monopolistic competition can earn economic profits. This happens when a company successfully differentiates its product and attracts more customers, allowing it to set prices above its costs. However, these profits don't last forever. The presence of profits attracts new firms into the market, each hoping to capture a share of the success. As more competitors enter, the market becomes more crowded and profits begin to shrink. Firms in monopolistic competition earn profits. It signals an opportunity for others. New businesses are drawn to the market, each bringing their own twist on the product. This increased competition puts pressure on existing firms to innovate and improve. Over time, the influx of new competitors reduces the market share and profits of each individual firm. This process continues until profits are driven down to a normal level, where firms just cover their costs. In the long run, the entry of new firms leads to a situation where economic profits disappear. Firms only earn normal profits, meaning they cover their costs but don't make extra. The market stabilizes, but competition remains fierce. Each business continues to differentiate its products, hoping to win over customers. This constant innovation is a hallmark of monopolistic competition, ensuring that consumers always have new options to choose from. One unique feature of monopolistic competition is excess capacity. This means that firms don't produce at the lowest possible cost or at their maximum output. Instead, they operate with some unused resources. Why? Because each firm faces a downward-sloping demand curve due to product differentiation. They could produce more, but doing so would lower prices and profits. As a result, firms intentionally leave some capacity unused. Excess capacity arises because firms in monopolistic competition want to maintain higher prices and profits. If they increase production to the point where average costs are minimized, they'd have to lower prices significantly, which would cut into their profits. Instead, they choose to operate at a smaller scale, keeping prices and profits at a comfortable level. This is different from perfect competition, where firms operate at full capacity. Let's compare monopolistic competition with other market structures. In perfect competition, all firms sell identical products and operate at full efficiency. In a monopoly, one firm dominates and can set prices freely. Monopolistic competition falls in between, with many firms offering differentiated products and some control over prices. This blend creates a unique environment where both competition and individuality thrive. Advertising plays a major role in monopolistic competition. Firms use ads to highlight what makes their products special, hoping to attract more customers. Whether it's a catchy slogan, a memorable logo, or a creative campaign, advertising helps build brand identity. This not only increases sales but also strengthens customer loyalty, making it harder for new competitors to break in. Innovation is constant in monopolistic competition. Firms are always looking for new ways to stand out, whether through product improvements, new features, or better service. This drive to innovate benefits consumers, who enjoy a wider variety of choices and better products. It also keeps the market dynamic, as businesses must adapt quickly to stay ahead of rivals. One of the biggest advantages of monopolistic competition is the wide range of choices available to consumers. Because each firm offers something a little different, shoppers can pick products that best match their preferences. Whether it's flavor, style, price, or quality, there's something for everyone. This variety is a direct result of firms' efforts to differentiate themselves in the market. Brand loyalty is another key feature. When customers find a product they love, they're likely to stick with it even if similar options exist. This loyalty gives firms some protection from competition, allowing them to maintain sales and profits. Building a strong brand takes time and effort, but it pays off in the long run by creating a stable customer base. Firms in monopolistic competition have some control over their prices, thanks to product differentiation and brand loyalty. Unlike in perfect competition, where prices are set by the market, these firms can charge a bit more if customers value their unique offerings. However, there are limits. If prices go too high, customers may switch to competitors. This balance keeps prices competitive but not identical. Besides adjusting prices, firms compete in other ways through quality, service, location, or even packaging. This is called non-price competition. For example, a bakery might offer free samples or a clothing store might provide personal shopping assistance. These strategies help firms attract and retain customers without starting a price war. Monopolistic competition, barriers to entry are relatively low. This means new firms can enter the market without facing huge obstacles. However, building a strong brand or loyal customer base can still be challenging. The ease of entry ensures that profits don't stay high for long, as new competitors are always ready to join the market. It's important to distinguish between short-run and long-run outcomes. In the short run, firms can earn above normal profits if they successfully differentiate their products. But in the long run, the entry of new firms erodes these profits, leading to a situation where only normal profits are possible. This cycle keeps the market competitive and prevents any one firm from dominating. Each firm in monopolistic competition faces a downward-sloping demand curve. This means that if a firm raises its prices, it will lose some customers to competitors, but not all. The unique features of its product provide some cushion but not complete protection. This demand curve shape reflects the balance between differentiation and competition. Downside of monopolistic competition is allocative inefficiency. Because firms don't produce at the lowest possible cost or at the point where price equals marginal cost, resources aren't used as efficiently as in perfect competition. This means society could, in theory, get more value from its resources if the market were more competitive. However, the trade-off is greater variety and innovation. Despite some inefficiency, monopolistic competition offers significant benefits in terms of product variety. Consumers enjoy a wide selection of goods and services, each tailored to different tastes and needs. This diversity is a direct result of firms' efforts to stand out and attract customers, making the market more interesting and dynamic. Monopolistic competition creates a dynamic market environment. Firms must constantly adapt to changing consumer preferences, new technologies, and emerging competitors. This ongoing change keeps the market lively and ensures that businesses never become complacent. For consumers, it means always having new options to explore. Customer feedback is crucial in monopolistic competition. Firms listen closely to what buyers want and adjust their products accordingly. This responsiveness helps businesses stay relevant and competitive. Whether it's through surveys, reviews, or direct communication, understanding customer needs is key to success. Technology plays a growing role in monopolistic competition. Firms use digital tools to design better products, reach customers online, and streamline operations. E-commerce platforms, social media, and data analytics help businesses understand trends and respond quickly. This tech-driven approach enhances both differentiation and efficiency. Operating in monopolistic competition isn't easy. Firms face constant pressure to innovate, differentiate, and maintain customer loyalty. The threat of new entrants means that no company can rest for long. Success requires creativity, adaptability, and a deep understanding of what customers want. For consumers, monopolistic competition means more choices, better products, and frequent innovation. The constant competition among firms leads to improvements in quality, service, and variety. While prices may be slightly higher than in perfect competition, many buyers are willing to pay for the added value and uniqueness. Excess capacity means that resources aren't used as efficiently as possible. Firms could produce more at a lower cost but choose not to in order to maintain higher prices. This inefficiency is a trade-off for the benefits of variety and differentiation. It's a key reason why monopolistic competition isn't as efficient as perfect competition. Over time, markets with monopolistic competition tend to evolve. Some firms grow and become more dominant while others exit. New trends and technologies can shake up the market, creating opportunities for innovative businesses. The constant cycle of entry and exit keeps the market fresh and competitive. Sum up, monopolistic competition is defined by product differentiation, many competing firms, and the presence of excess capacity. Firms can earn profits in the short run, but competition drives these down in the long run. The market offers consumers variety and innovation, but at the cost of some inefficiency. Understanding this balance helps explain why so many real-world markets fit this model. Monopolistic competition is all around us, from coffee shops to clothing stores. Its blend of competition and individuality creates a vibrant market full of choices and innovation. While not perfectly efficient, it offers benefits that many consumers value. By understanding how this market structure works, we can better appreciate the variety and creativity in our everyday purchases.